How's it, guys? Welcome back to another video. Today's video is a bit different. I've been teaching you guys everything that I know about ICT concept individually. So now, did you know that you can combine all of those concepts to make killer entry model, right? So today's video is about ICT multiple concept to create a strategy, right? So what are we doing? We're going to look at maybe 3, 4, or 5 ICT concept and build a strategy upon them. So the first thing that you are going to look at is we have to find our buyers. Where do we find our buyers? I already told you guys that I like to use to find my buyers on the daily time frame. So we are on the E-mini Dow Jones features on the daily time frame. That's where I like to find my buyers. So if you can see, we have the market making a series of high highs and higher lows, right? The market makes a high, the market makes a low, the market makes a higher high, the market makes a low which is higher than the previous low. So we can see the market is breaking highs and making higher highs. That means our structure is bearish, bullish, right? We have the market breaking this structure. So when the market breaks this structure, we expect the market to trade down into a discounted area or into a PD area on the daily time frame before it can buy, right? So the market moves from premium to discount, discount to premium, liquidity, buy side liquidity to sell side liquidity, internal liquidity to external liquidity, and so far. So now we have this high and we have this ICT PD array, which is known as our volume imbalance. It's a volume imbalance and a gap at the same time. Why is it a volume imbalance? The volume imbalance is a two candlestick pattern whereby the bodies of the candles does not overlap. The wicks may overlap, but the bodies do not overlap. So if you can see, this candle closed here and the next candle opened here. So the bodies do not overlap. And a gap is when there's a complete absence of candle in the market, right? So if you can hear, we have the market opening here and closing here, and the wick closing here, and the wick high being here, and the low being here. So this low and this high and this low do not overlap. So we have a gap here. So we have a volume imbalance and a gap at the same time. So now we expect the market, after running this liquidity to the upside here, to come into the volume imbalance and into this gap before going up and taking out this high again, right? So now we know that our bias is bullish. Now let's go to the 15 minutes time frame and look at our liquidity pools. Here we are on the 15 minutes. We have this high here. This is the previous high on the daily time frame, which was taken here, right? The low is somewhere down here. So this was the low, this was the low. So we expect the market, after this high, we expect the market to come into this volume imbalance and this gap, right? So on the 15 minutes, it's a complete gap because it's a new day opening gap, right? You can put it as that. But on the daily time frame, we have a volume imbalance and a gap. So we expect the market to come into this gap and this volume imbalance and hit the 50% of it before going up and attacking this buy side liquidity, because this is our draw on liquidity. This high becomes our draw on liquidity. So what do we do in this instance? We mark up our buy side and sell side liquidity. Our buy side liquidity is this high and our sell side liquidity will be this low, right? So we are waiting for the market to come in between, sorry, to come below this internal liquidity. It's an internal liquidity because this is our external liquidity. This is our external buy side liquidity. This is our external sell side liquidity. So anything in between this low and this high becomes our internal liquidity. Fair value gaps do not have liquidity. Get that into your head, right? Fair value gaps do not contain liquidity. Liquidity is found in highs and lows, both external and internal. Internal lows or internal highs, or internal or external highs and external lows. Right? So now we have our buy side liquidity, we have our sell side liquidity here. Right? So now what do? We wait for the market to come and raise this sell side liquidity here and tap into the 50% of this volume imbalance and a gap before going up, right? So we also have the market making this low again. The market have making this low again, which was taken here, right? So now when this market was taken and tap into the 50%, we'll go to the 1 minute time frame. Let's go to the 1 minute time frame, and that's where we are going to search for our entries. So our position is going to be something like this. This is a 15 minutes liquidity, and now let's look for our 8:30 opening. Why 8:30 opening? This is our 8:30 opening. This is our 8:30 opening, right? So now this is our sell side liquidity, and now because our last low before 8:30 is this one, we are going to use this one as our sell side liquidity. So we're waiting for this sell side liquidity to be taken and this one to be taken before. So if you can see, the market took out this liquidity here made this low here, then the market broke structure to the upside, right? So when the market is breaking structure to the upside, it's inducing people to go in, because when people see this now, they expect that this now is a protected low because the market broke structure to the upside. That means the market is going to go up. But we know that because this is the last low before 8:30, the market has to take out this liquidity before it goes up, right? So you're going to wait for the market to come into this low and go up from there. This is our inducement. So people see this structure, they buy here and they put your stop loss above this low. So now this low has been raided again because there's a ton of liquidity down here. This is our liquidity. Our liquidity is based here. So now we see the market going below this low. And when the market goes below this low, that's when us smart money traders like to buy. Right? Why are we buying here? Because we took out our internal liquidity. So now we wait for the market to come and displace to the upside, then take our position. So if you can see, we have another ICT concept. We have what? We have the three drives pattern. We have the first drive, the second drive, and the third drive. The three drive patterns are a reversal pattern by ICT. Right? So that's our first ICT PDRA that we can use, our the three drive patterns. The second pattern is what? We have our breaker block here. We have our breaker block here, which is our next ICT concept. The three drive pattern, our breaker block. Then the third thing that we have here is we have our fair value gap here. We have our fair value gap here, and we have our fair value gap here, and we have our market structure shift from this candle. So when this candle closed above here, we have our market structure shift. So now the first, we have three drive patterns, we have our breaker block, we have our fair value gap. So those are our three PDRs that we're going to use. So we're going to take your position, your buy position at the 50% of the fair value gap or at the open of the breaker block here. You have a breaker block here, then you put your stop loss below this protected low, and the first target that you're going to target is this high. This high becomes your first target. Then you go left, then you look at the previous daily high. The previous daily high is this one. Our external liquidity is going to be your second target. So your position is going to be something like this. If you're willing to hold for multiple days, you can hold. But whenever you hold when the market breaks, when the market is here and it broke this structure to the upside, you put your stop loss below this low. When the market is up here, your stop loss is below this low. So you keep on trailing your stop loss until the market takes out that previous high. So if your stop loss is here, during NFP here, you're going to be stopped out. But if you can see, the market did exactly that and went to the external liquidity. So that's how you trade. That's how you combine ICT concept to create a strategy. Our concept here were the three drive patterns, we have our breaker block, and we have our fair value gap. Right? Then we have our market structure shift. All of these are occurring inside a higher time frame gap and a volume imbalance. So that is further confirmation that the market is now going to go up. If you are a resilient person, you don't have to take partials. You don't have to trail your stop loss, but take partials. When the market is trading above a high, you take partials, right? Okay, guys, like I said, this is an example of when we are using multiple ICT concepts to create an entry model. Here we used our three drive patterns, which is the first drive, the second drive, and the third drive. We also used a breaker block here, and we also used a fair value gap, right? So now we didn't use any discount and premium, but it's an important concept. But sometimes the market does not go deep into a discounted area for you to buy. So we used three drive patterns, fair value gap, and a breaker block. All of these are happening inside a range on the all of these are happening inside the daily volume imbalance and a gap, which is our bias. Our bias on the daily time frame is we're waiting for the market to retrace into the volume imbalance on the daily time frame before it buys. But you cannot buy on the daily time frame because that will require a lot of capitals, because your stop loss has to be very huge. So you scale it down to a 1 minute or 5 minute time frame, and you look for ICT concept that you can combine together and get an entry. So your entry is going to be like this. You buy here, you keep your stop loss below this protected low, and you target the daily high. The daily high becomes your draw on liquidity. You can move your stop loss accordingly as the market keeps on going up. But if you don't want to move your stop loss accordingly, you can take partials. When the market breaks this high, you take your partials. You leave your stop loss here, and when the market comes and make this high here, you take another partials, right? When the market comes and make a high, because market structure will dictate to you how to manage your trade. Because when the market keeps on breaking highs and making higher highs and higher lows, you know that the market structure is bullish. So it's safe to take partials because the market will keep on going up until you see the market closing below a certain low, right? But if you don't want to take partials, you can trail your stop loss. You trail your stop loss, trail your stop loss until your stop loss become taken. So I don't like trading when it's NFP time. Sorry, I don't like trading when it's NFP, right? Because NFP is very volatile. Like here, if the market is here and you put your stop loss here, then when NFP comes, the NFP candle comes and wicks down before going up again. Because our bias is here, we are very confident that the daily high is our draw on liquidity. Okay, so you can either choose to trail your stop loss or take partials or do both. So guys, if you've enjoyed this video, please consider subscribing, liking, and sharing this video with your friends and family. Subscribe, support local YouTube. See you next time. Peace out.